What is an automated investment service and how can one help you invest? How did Wealthfront grow to more than $1 billion in assets under management? And is it really better and even possible to invest in all 500 companies of the S&P rather than simply buying an index fund or ETF? We'll answer these questions and more on this, the 138th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody. Hope you're having a great day. I am very excited about the interview that I have for you today. It's one that I was looking forward to as I worked to schedule it. And I really enjoyed this interview. I had a chance to talk with the CEO of Wealthfront, Adam Nash. Wealthfront, as you may know, is what I would call a robo-advisor, a term, by the way, that Adam and the folks at Wealthfront don't care for. And I guess I don't blame them. They prefer to refer to what they do as an automated investment service, and that's exactly what it is. Of course, we've talked about this in the past. In podcast 132, I talked about companies like Wealthfront, including Betterment and Motif Investing and Acorns and the like. These services that have sort of popped up over the last, 2 or 3 years that help folks invest. They automate the process of deciding on an asset allocation, actually investing in the funds, rebalancing, and even for taxable accounts, tax loss harvesting. So I've talked a lot about Betterment. I haven't talked as much about Wealthfront, and it's one that I've been personally very interested in. And I will tell you, I think you'll enjoy the interview with Adam. After the interview, he and I kept talking for, I bet it was 20 minutes. A great guy, incredibly knowledgeable. I think whether you end up using one of these services or not, whether you ever use Wealthfront or not, I think you'll get a lot out of this interview. I know I did. I can tell you that after the interview, I opened up a SEP IRA at Wealthfront, and I'm going to talk more about why I did that and what the experience was like in a future podcast. Today, I just want to focus on the interview, so let's welcome Adam to the show. Adam, welcome to the show.
Thank you. Glad to be here.
I am thrilled that you're on the show. Wealthfront, I've been on your website, which is a fantastically designed website, and have wanted to talk to you for a while because I think what you guys are offering is really great, and I want to. A lot of it's self-interest here. A lot of podcasts I do for the listeners. This one I'm doing for me, for them too. So I guess as a starting point, Adam, why don't you sort of tell folks who you are and what you do?
Sure, happy to. My name is Adam Nash. I'm the president and CEO of Wealthfront. Wealthfront's the largest and fastest growing automated investment service out there. We now manage over $1.6 billion, and we're less than 3 years old. We launched in December of 2011. For me, this is a dream job. I've been interested and passionate about investing in personal finance for decades, since college. I actually have my own personal blog on the topic, going back almost 10 years. But I came out of school focused on software and design, and really this challenge of how can technology help people do the things that they do better. And I've worked at companies like Apple, eBay. Most recently, I was the vice president of product at LinkedIn. And so I really have liked going after big markets where there are clear problems facing a lot of Americans, where I think technology can add a lot of value. And there's no question in my mind that automating the best practices around investing is one of those huge areas that has resisted disruption in the past, but is ripe for a change. And so I joined Wealthfront a little less than 2 years ago. We had less than $100 million under management when I joined. And in the last 2 years, the growth has just been phenomenal, right? More than 1,500%. And so we're excited. I'm excited. I get the opportunity to build a fantastic team doing brilliant work in investment research, in software and in design, and hopefully add a lot of value for millions of individual investors who frankly need it.
Yeah, that's great. And you mentioned you had a personal blog. Do you still keep that updated?
I don't get to do it as much as I used to. It's still there. It's called Psychohistory.
Psycho history. Okay.
Famous science that Isaac Asimov defined in his Foundation series. It was based on the idea that actually there's the science to the irrationality of people. So I studied human-computer interaction, and one of the big challenges when you do software is you realize that machines are actually incredibly logical. The hard part is that humans are emotional when they use technology, and so building great solutions is rarely as simple as lining up the ones and zeros. And I found this fascinating overlap with behavioral finance, which is another passionate area of mine, where once again, money is very rational. The dollars and cents really do add up. But humans are very emotional about money, and they make decisions in unpredictable ways. And so the idea of the blog was to kind of talk about a mix of topics. But it's a personal blog. And actually, I do most of my blogging today on the Wealthfront blog, so it's not quite as exciting as it used to be.
Well, I'm looking at it now, and I will link to it in the show notes so folks can check that out if they're interested. So, all right, well, tell us about Wealthfront. How does it help people become more effective investors?
It's actually very simple. I mean, I think, like I said, Wealthfront is a relatively new service. It launched just in December 2011. And before Wealthfront launched, I think there was a lot of skepticism about the idea that people would use an online service to manage their money. No one had coined the term an automated investment service. No one even thought that was a category. When we hit $1 billion in less than 2.5 years, right, which we hit in May of this year, a lot of that skepticism vanished, quite frankly, and flipped over to more open-minded questions of why is this working? Why is there so much growth? Who are the people trusting their money to the service, and why are they doing it? And so I think to explain Wealthfront quite simply, it really is an automated investment service. It's designed to be incredibly simple, right? You go through a basic analysis of your risk tolerance, which is based on both objective and subjective criteria. That gives you a risk score, which maps to a level of volatility that you can tolerate in your portfolio. We've done all the hard work of finding the best ETFs, 11 different asset classes, as ranked by low cost, but also tracking error and other sophisticated techniques, liquidity. And then we give you a portfolio across up to 11 different asset classes, optimized both for taxable portfolios and tax-deferred portfolios like retirement accounts, IRAs, etc. Now, if you want to use that portfolio advice, it's free. You didn't even have to give us an email address. So if you want to go to your brokerage account and you like to do these things yourself, you can go and buy that portfolio. What people pay Wealthfront for is actually the automation, right? If you want Wealthfront to do it for you, it's incredibly easy. You link your bank account. You can transfer over a brokerage account. We will take care of not only investing your money in the ideal portfolio for you, but we automate all the best practices that individual investors should be doing, but too often aren't, right? We do trigger-based rebalancing. We do intelligent dividend reinvestment. We do tax loss harvesting. And for larger accounts, we have features like the Wealthfront 500, which actually gives you the ability to optimize for tax losses within an index. And so we offer a range of services. We're known in the category as the innovator. Most of the features which have defined the automated investment service are things that we launched first. And we're just excited. We think there's an incredible array of things that we can do to automate investing for people so that they don't make the mistakes that too many of us succumb to when we're managing our own money.
Okay, well, you've given us a lot to work on here. Let me kind of break it down in maybe in a piece by piece fashion here, just so we can sort of digest everything you've just said. Let's begin with this. What account types do you offer?
Oh, good question. So, as I mentioned, we have both taxable accounts and retirement accounts. For taxable accounts, they can be personal accounts, joint accounts. We also support trust accounts and even corporate accounts like LLCs. For retirement accounts, we support normal IRAs, traditional. We also support Roth IRAs. And for small businesses, we support SEP IRAs as well. Okay.
So let me address sort of one of my first personal hiccups for using a service like what Wealthfront offers. And that's the 401k. So if I were to move my IRAs and my taxable accounts over to, say, Wealthfront, as I understand it, I can't move my 401k. And so I might get the convenience of Wealthfront for those accounts that I move over, but I'm still kind of stuck doing all of the rebalancing and dealing with, dividends and all that sort of thing for my 401k. Is there any, first of all, am I right about that? Wealthfront can't help someone with a 401k.
Well, there's actually two cases of the 401k. For your current employer, you are correct. If you are currently employed at a company that offers a 401k and you take advantage of it, you can't roll that over to a third-party service. However, as you probably know, most people switch jobs fairly frequently. And actually, that's becoming more common instead of less common. And when you leave a company, there's too many individuals, quite frankly, who leave their money in, frankly, a substandard 401k, one with poor investment choices, poor service, and high fees. And actually, people very often do roll over those 401ks once they leave their job for a new job to a service like Wealthfront.
Right. And they can obviously roll it over to Wealthfront. Sure. That makes sense. But I guess, so then the question I have is for my current, my 401k at my current employer, do you see down the road the industry somehow being able to work with that kind of 401k? Or is that just, at least as far as we can see into the future, not something that's possible?
The 401k is a bit of a painful subject for me, but having seen firsthand how earnest 401k committees trying to do the best thing for employees are limited in terms of the options they have available, it's quite frustrating if you're passionate about personal finance and investing options for individuals. I think the reality is that 401ks do see some forms of improvement, right? Many 401ks offer some form of automatic rebalancing, for example. But it's very hard to advocate. Most 401ks have very poor fund choices. They don't cover all asset classes, and they tend to have exceptionally high fees. And more importantly, those fees are rarely disclosed properly, right? They're built into fund costs and other costs that plague the individual. So with a few notable exceptions, there are some exceptional 401ks out there. Most people switch jobs quite a few times in their career. I think that actually right now for young people, remember most of our clients are under 35, most young people switch jobs every 2 to 4 years. Our best advice is take full advantage of matching, take full advantage if you can of the tax deduction. But when you leave your job, take advantage of the fact that you can now roll your 401k over to a service with lower cost funds and better selection and costs.
Sure. Well, why doesn't Wealthfront get into the 401k business, or is that just not quite so easy?
Well, we're not even 3 years old, so it's,
all right, fine.
We're trying to grow as fast
Adam,
as we can,
sometimes
your eyes can be bigger than your stomach. I think frankly, it's a very common request that we get. I don't think that we're alone in being dissatisfied with the 401k options. The truth of the matter is the 401k business is a very difficult business to get into. It's a large enterprise sale. There have been startups that have tried to get into that business, most notably Financial Engines, which is a public company worth billions of dollars. But it took them a long time to make a dent in that business. We would love to find a way to help people with their 401k accounts. But right now, what we've discovered is that for young people, actually, while they are saving for retirement, in the ideal case in their 401ks, there's also a lot of other savings goals that they're saving for. And the appeal of an automated investment service is incredibly valuable to them. And because they change jobs so frequently, the fact that for a couple years they have some assets in a 401k is really a short-term issue, right? Eventually they'll leave that job, they'll move to another one, and they can roll that 401k in with all their other money at a service like Wealthfront.
Sure. All right. Well, I'll tell you what. We'll give you till next year to get the 401k worked out. Just kidding. All right. So here's my next hurdle. For taxable accounts, I don't see how I could move my taxable accounts right now without triggering significant tax liability. And am I correct? Am I missing something? Is there any way for me to take taxable accounts that have unrealized gains and move them to Wealthfront without incurring the tax liability?
Actually, I love this question because it's a very real issue. Now, as a reminder, I will tell you most of our clients are under 35, and for many of them, this is their first investment account, right? So we tend to run into this problem with either savers who got an incredibly early start with investing, or folks who are a little bit older who've acquired an investment account, not just having an investment account, but one that's old enough to actually have accrued significant gains.
Yeah, that's me. I'm the old guy.
Well, no, I think it's a great question, and I think it's smart of you to bring it up because actually I've seen too many people ignore taxes as a very real investment concern. You'll see people who are well-meaning, who are so worried about 10 or 20 basis points on expenses that they'll incur thousands of dollars in immediate tax liability, not really doing the math on what's more important. So I love that you raised the issue. So the short answer is actually we do take taxes into account, right? So we're one of the few services out there that have supported brokerage transfers from the beginning. If you move assets to us through a brokerage transfer, right, thanks to some regulatory changes, we actually are aware of the cost basis that you originally paid for these investments. And there are cases where we will not migrate assets immediately to the ideal portfolio. There is mathematics that you can do weighing the benefits of a diversified portfolio with features like tax loss harvesting versus the taxes that you would pay in the short term if you liquidate. And so it doesn't come up as often with younger customers. But if you do a brokerage transfer for Wealthfront, you will be given options about how long you want to take to translate your current portfolio into what we consider the ideal portfolio.
Interesting. So I can transfer investments in kind, and you will hold them, and maybe, again, depending on the specific circumstances, I might slowly convert those into the Wealthfront ideal portfolio over a number of years.
That's right. So we see people do this a couple of different ways, right? So one way is by transferring assets. Sometimes they have multiple accounts, and they might do one account one year and another account a different year. It's not uncommon for people to actually have many investment assets, especially older investors in different places. Or in-house, we can actually give you some control over that process. But
Okay.
actually, I love, like I said, there are situations, to be clear, where, if you've been holding the S&P 500 for 20 years, right, an S&P 500 fund, you may be sitting on enough embedded gains that even though it would be better to be in a more diversified fund like VTI, it may never make sense to sell that.
Yeah.
Possible. And, so we pride ourselves on being tax efficient and tax aware. I think we were the first automated service to even offer tax-related features in the first place. And so I love that you're bringing up this issue. And I think that especially for older investors, being smart about taxes, Bert Malkiel, who's our chief investment officer, wrote the book, A Random Walk Down Wall Street. He has a great way of putting this where he says there's really three things that you can control, right? You can't control the financial markets, right? They go up and down. You have no control over that. What you can control are fees, diversification, and taxes. And there's quite a few investors who ignore that third bucket. It really is very important, right? Some of these tax-efficient procedures, even being smart when you're withdrawing money, about choosing the lots that have the lowest gain, right? So you minimize taxes on withdrawal, can have a phenomenal effect on the overall performance of your portfolio for the long term.
Right. Okay. Well, you mentioned fees. So my understanding with Wealthfront is that that for accounts over $10,000, I guess the first $10,000 there's no Wealthfront fee. Above that, it's 25 basis points plus the costs of the ETFs.
That's correct.
Okay. So one question is then, why Wealthfront? Why not just buy a Vanguard target date fund?
I think the Vanguard Target Date Fund is a phenomenal product. Target date funds have had a mixed history, and there's a variety of allocations, and some of them are layer fees on top of fees that are counterproductive. But I think the Vanguard Target Date funds are a great example of a target date fund done well. So target date funds, I think, are a great product. The one thing that limits the target date fund is actually the fund structure itself, right? In the end, it's a single one-size-fits-all financial product. So to give you an example, if you have a 30-year-old who makes $50,000 a year and has saved $100,000, they're in a very different financial situation than a 30-year-old who makes $100,000 a year, but has only saved $20,000, right? Their risk tolerance just isn't the same. Their financial situation isn't the same. But the target date fund uses age as the single indicator of how much risk you can take or you should take. And that's an oversimplification that's kind of required by the ability to kind of shift fund products. You can think of Wealthfront, at least in its simplest form, as taking a lot of the benefits of the target date fund, and instead of implementing them as a mutual fund, we've actually implemented them as personalized service for your brokerage account, right? So you get the same automatic advantages of asset allocation, rebalancing, dividend reinvestment, but you get the flexibility to have more asset classes, the flexibility of personalized risk tolerance. And most importantly, when it comes to taxes, I mean, this may sound like a little bit of a historical detail or trivia point, but it turns out that the 1940 Investment Company Act, even though that happened almost 80 years ago, still has a profound impact on what mutual funds can and can't do. Mutual funds have to distribute gains and dividends every year to a certain extent, but they're not allowed to ever distribute losses, right? And so it turns out that there are certain things you can do in an individual account, something like Wealthfront, that you can't do in a mutual fund. So tax loss harvesting is a perfect example of that. The Wealthfront 500 is a perfect example of that. And so those types of advantages have been enjoyed by the ultra wealthy for quite some time. Wealthfront has automated those services in software so that everyone can have access to them.
Okay. Well, let's talk about tax loss harvesting. I want to talk about Wealthfront 500 because that's just an amazing thing to me. But putting that aside first, just talk about tax loss harvesting in general. How does it work? How does Wealthfront make that work?
Well, I'm glad you brought it up. So they're really two very different things. Tax loss harvesting as a service is something that we rolled out 2 years ago and has now been broadly copied, I think, in the industry. It's become a standard for a feature for an automated service. The original idea with tax loss harvesting was that ETFs offer an amazing opportunity to do something automatically that wealthy financial managers had done by hand for decades for wealthy individuals. With tax loss harvesting at the ETF level, instead of picking one ETF for a given asset class, like emerging markets, we actually pick two. And that gives you the ability that if emerging markets go down, I think you and I both know that sometimes they go down, you have the opportunity to sell this year the first ETF, take the loss, so you get immediate benefit on your taxes this year, but still buy the second ETF so that you still have a diversified portfolio. So when emerging markets goes back up, and by the way, they always seem to go back up, you're not undiversified. You still can participate in that upside. And so it turns out this is a very hard thing to do by hand, especially across 11 asset classes. It turns out to be very easy for a computer to do, right? So in the real world, previously, you had to have a huge family office potentially with tens of millions of dollars, if not hundreds, to pay a team of people to do this for you. In software, this could be inexpensive enough that we could offer it to many of our investors as an automated feature.
So you have...
Oh, sorry.
I was going to ask, you have two ETFs for each asset class?
That's correct.
And again, is that just to avoid the wash sale rule, effectively?
That's correct.
Yeah.
Right. So we use ETFs that are actually mapped to different indices. Right. They're two different securities. And what
triggers the sale?
Sorry, go ahead.
Well, I was going to ask, what triggers the sale? Like, is there a certain percentage loss in a asset class that would trigger Wealthfront to sell that ETF and buy the second one?
It's a very perceptive question. So we just celebrated the second anniversary of our service with our third generation tax loss harvesting engine. And actually, this is one of the features that we uniquely offer. It turns out there's mathematics based on how volatile a given asset class is that determines what the right threshold would be. And our new engine that we've upgraded this year actually has a different set of thresholds for every single one of those asset classes, right? That percentage that you're looking for turns out to be different for emerging markets than it is for muni bonds.
Right. So it's tied to their volatility, their standard deviation. So
That's right.
It would be different. Presumably, a more volatile asset class would require a greater loss before triggering tax loss harvesting than an asset class that didn't have the same volatility.
Yeah, it's one of the fascinating areas about this service. It turns out when you implement things in software, you have to think deeply about the math and the rules. I mean, Historically, the way people did tax loss harvesting is, either you yourself or maybe an advisor would get to be November, and there'd be a little bit of like, well, maybe you should sell your losers to kind of pay for some of the winners, right? That for the most part, you could always buy them back next year.
You've just described my process.
Yeah.
Right.
Actually, we did some of the research. There is some value to be had there, so it's not bad advice. It turns out to be less than half the value by our analysis that you can get by actually looking at it on a daily basis in a more automated fashion. I mean, the problem with tax loss harvesting for individual stocks is that, if you sell Apple, there really isn't a comparable stock, right? Google is not Apple. Tesla is not Apple. No matter what people say, Pepsi is not Coke and Coke is not Pepsi. With broad index funds, however, even if they're different indices and different securities, mathematically the correlation is high enough that you don't lose a lot in terms of diversification by doing the swap. So, it's a highly effective thing, but it is one of those things that's very, very hard to do yourself, doing that math every day.
Right.
I mean, in 2013, most of the tax benefit that tax loss harvesting offered our clients happened in 3 weeks in June. Did we know that ahead of time, that there'd be a rough 3 weeks in June, for emerging markets and a few other asset classes? You couldn't have predicted it. This year, obviously, September and October were brilliant months for tax loss harvesting. I mean, the markets have largely recovered now. But, Wealthfront clients enjoyed an automated service that was, A, smart enough to be watching the markets every day, and B, was unemotional enough to jump in and do all those right things you're supposed to do, like rebalancing and tax loss harvesting, on the days where most individuals, frankly, had the least incentive to actually watch the market. Right? It was just painful. That's the benefit of automation.
For clients, so first of all, tax loss harvesting, of course, only applies to taxable accounts, right?
That's correct.
Yeah. And then for clients that use this, well, first of all, do you have to have a minimum invested in a taxable account to get this level of service?
You do. Our current research shows that to get real benefit from the service, you need $100,000.
Okay. And for a client that has that, can they log into their account and see all of this happening? Hey, we just sold and bought something else, and you have tax losses for this year right now of whatever, $2,000.
That's exactly right. Actually, it may sound counterintuitive, but we might be the only investment service that actually puts the amount of losses that you've harvested this year on your dashboard when you log into Wealthfront. We really want people to recognize that saving money on taxes really is additional money that you have now to invest for the future, right? If you save $400 on your taxes, that's $400 more that you have to save.
Right. Now, let me play the devil's advocate here a bit. So I think you guys have written papers to quantify the advantages of tax loss harvesting, and I'll dig them up, or maybe someone can send them to me. I can include them in the show notes. But, with tax loss harvesting, you're not avoiding taxes, right? You're delaying them, which, of course, has value, obviously. I mean, that's what a 401k is, or an IRA, traditional. It's a delay of taxes. But I'm curious, when you quantify in your white papers and whatnot, the advantages of tax loss harvesting, are you factoring in that that it's really just it's a delay, and that eventually, of course, you're gonna effectively lower your cost basis. Eventually, you're gonna have to pay the taxes. You just get a reprieve, so to speak, and pay them later.
Yeah, it's a great question. So we recently updated our white paper in October with a lot of new research, and I think we were the first firm to not only look at historical time periods, but actually do Monte Carlo simulations across hundreds of thousands of different potential futures to see what happens if you do tax loss harvesting for 10, 20, even 30 years. And in that modeling, we also look at what happens in the future if you keep compounding your portfolio, if you liquidate half the portfolio, or if you liquidate the complete portfolio. So we try and give a full picture. It turns out that liquidation strategies, right, when you retire and you're living off your portfolio, can vary a wide band, right? People move to different states. They have different tax rates. Sometimes they donate their lowest cost basis shares to charity or leave them for inheritance, where they live off the highest cost basis shares. I mean, the truth is it's a very individual process. But we took our best attempts in our research of giving people a range of different options and showing how that affected it. And as you pointed out, it turns out that there's two benefits that are very significant in terms of doing tax loss harvesting. The first is just tax deferral. You brought up a great example, right? Whether it's retirement accounts or 401ks, the ability to defer taxes means that that money that you save this year can compound for 10, 20, 30 years. And that has immense value over long time periods. The second source of the value is the fact that actually short-term capital gains have a very high tax rate and long-term have a lower tax rate. And that's different across the country depending on the state you're in, but there's always a difference. And so the idea of taking short-term losses but holding investments for long-term gains also has value over long periods of time.
Okay.
So those are the two primary sources of value in tax loss harvesting.
Now, where are the assets held? Who's the custodian? Are you guys a custodian?
We are not the custodian. We use a third-party custodian called Apex.
Okay.
They're not a consumer custodian.
Right.
You can't go to their website, open an account.
Right.
But we actually take pride in the fact that we have a third party holding your assets. Right?
Okay.
I think we've all learned that there are some dangers. I shouldn't say that. I should just say there's a lot of extra security and value in having a third party that not only is holding your assets, but also is auditing and validating all of your investment statements.
Right.
So you don't have conflict of interest of your advisor also being the one telling you how much money you have in your account.
Yeah, because there are some in your space that I think act as a custodian, actually. So
I don't know of any.
Well, I won't name any names.
I do. It turns out there's a wide range of investment services that firms can do for their clients. Like I said, one of the differentiating factors for Wealthfront, if you look across the industry, is actually our average account size is quite large. It's much larger than most. We have accounts ranging from $5,000, which is our minimum, all the way up to $10 million. And our average client has about $90,000 with us. And so we're a little bit more optimized for security and that third-party validation than other startups. We take pride in that because we think that if you're going to trust your money to a service, having those extra layers of protection and auditing are really valuable.
Yeah, absolutely. Okay. I kind of inserted that because I wanted to make sure I asked you, and I'm sure it's probably some on your website, but I wanted to know who the custodian was. But I kind of interrupted our tax loss harvesting discussion because I'd love to hear about Wealthfront 500.
So I love that you brought this up because it's a good story. Our best success at Wealthfront has come from looking at the things that the ultra wealthy get in terms of financial services, and seeing if there are good ideas there of ways we can put them into software and bring them to a much broader audience. And the Wealthfront 500 is a great example of that. So it turns out there's a number of firms that have done this for the ultra wealthy for decades, right? There's a very famous firm called Parametric that now manages over $100 billion that literally has been doing stock level tax loss harvesting for decades. And so when we were discussing what was the next innovation we could bring to this market after doing ETF-level tax loss harvesting, Bert Malkiel actually was the one who suggested and said, well, while there's a lot of value to be had in doing tax loss harvesting at the asset level, there's a lot more volatility in individual stocks. And he talked about Parametric and Aperio and other firms doing this. The problem with those firms is you can't open an account with Parametric and Aperio. You have to have a traditional wealth manager, usually with a very high minimum, I'm talking $5 million or more, who will then be able to put a slice of your account into those firms. And by the way, there are fees on top of fees for using their services. So with the Wealthfront 500, we brought the service directly to the consumer. And as you've mentioned before, the Wealthfront 500 is actually a very simple idea. It basically says that if you have enough money, instead of buying an S&P 500 index fund, we can actually buy all 501 stocks, market weighted, in the S&P 500 in your account. But instead of just optimizing for tracking error, which is what a typical index fund does, we are also free to optimize for tax losses because stocks go up and down throughout the year.
And what kind of, so if a stock, so again, do you take the same approach where you have some sort of volatility measure and a certain loss percentage triggers action?
No, it actually turns out to be not as simple as the ETF.
I can imagine.
Level asset. But like I said, there's no way to pick a stock that's the same as Apple. There's no real match for General Electric, right? It turns out that every company is different. It actually turns out the way to solve it has actually been pretty well established, like I said, by firms like Parametric. The reality is that any given day of those 501 stocks, there's a certain set that are candidates for harvesting tax losses. Like as you mentioned, that they're significantly down from the point where you bought them. What our software does is it says, well, on this given day, if there's a certain set of stocks that could be harvested for losses, is there another set of stocks that we could purchase that actually would keep the tracking error in the index relatively low, right? Because you want to match the index. This is, in the end, designed to be an index fund. And so sometimes it turns out there isn't another set, right? There's 18 stocks today that you could harvest for losses, and you can't find another set of 20 or 25 stocks that would match them. But it turns out that on many days, you can find that match. And so just by taking advantage of all that individual volatility, you can end up with an index fund that has very low tracking error in terms of matching the index, but can generate a significant amount of tax losses in a given year. So our software looks at the market every day for opportunity, but it doesn't necessarily trade every day. In fact, our rough estimate is that it probably trades every third day or so, depending on your personal account and deposits you've made, et cetera.
Do you have data, performance data, and tax loss harvesting data that you publish for your Wealthfront 500?
We do. So it's a new service that we launched in December of last year. We're actually coming up on our 1-year anniversary, and so we'll be putting out additional data in the coming weeks. But if you actually look at the white paper that we pushed out when we published it, we actually did analyze this algorithm over a number of rolling historical periods and compared it to traditional S&P 500 products like SPY, the most famous ETF in the category. And so what you see in the research is that actually, for a little bit more tracking error, right, a little bit more volatility in terms of the difference of how it tracks the S&P 500, you can actually generate a significant amount of tax savings, actually more than 2% in tax savings in the examples that we used over different rolling historical tax periods. So that's a huge advantage.
By 2%, would that mean that I would have tax losses of, say, $2,000 for every $100,000 invested? Or am I using the 2% wrong?
Remember, they're averages, right? Markets are different every year.
Sure.
Right? So we looked at rolling 10-year periods to kind of average them. But that's roughly the right math. The only caveat I would give you is that remember this is for your U.S. equity portion of your portfolio, right? You're still using ETFs for your diversified portfolio on muni bonds, on international stocks, emerging markets, real estate, etc. So and for our average client, we tend to have them somewhere between 1/3 to 40% of their portfolio in U.S. equity.
Right. So, but effectively, you would have tax losses of some amount, presumably, every year, even when the stock market, even when the S&P is up by 20%. You'll still have
absolutely.
You'll still have losses.
That's the whole point. I mean, this year is a perfect example. I'm obviously a client of the service, but this has been even though the S&P is up, actually surprising many people, the S&P 500 is up significantly this year, right? So when you look at the year-to-date performance of the S&P 500, you might say, well, there wasn't a lot of opportunity for tax loss harvesting the S&P 500 up. But there's been so much volatility in individual stocks that actually it's been a fantastic year for tax loss harvesting. I mean, that you're really getting to the heart of why the service is so valuable, right? Index funds tend to hide a lot of the underlying churn and movement in the stock market.
Right.
Right? The S&P 500, actually for many people might be too volatile these days. But fundamentally, it goes up and down, but it tends to be an aggregate of 500 stocks. The total U.S. market, like Vanguard total market, VTI, you're talking about over 3,000
Right.
stocks.
Right.
But there's so much volatility under the covers. And what the Wealthfront 500 does is it takes advantage of the fact that the way our tax system works is that taxes are due this year only on transactions that are done this year. So taking a loss really does have short-term value, especially if you can keep your portfolio diversified and then reinvest that loss for the long term.
Yeah. So I think I read that the minimum balance you need is 500,000. Is that right?
That's right. The current minimum for the Wealthfront 500 is an account of 500,000.
Now, is that a 500,000 across all of your accounts with Wealthfront, or just the amount that's allocated to the Wealthfront 500?
500,000 is actually for the taxable account. The Wealthfront 500 doesn't make sense. Tax loss harvesting doesn't make sense for retirement accounts.
Right. Oh,
That
of course. Right.
Is 500,000 is because it turns out there really are 501 stocks in the S&P 500. A share of Apple really is actually I don't know what it is these days. It's higher than it used to be. I guess I had it split, but Google is like $500 a share.
Apple's 115.
Yeah. So if you do the math to do a market weighted portfolio, particularly for the smaller companies, you need a certain amount of money to actually do a good job of mimicking the index. And so it turns out that remember the numbers I mentioned earlier, for a $500,000 account, you might have a third of that account in U.S. equities. That turns out to be enough money to do the Wealthfront 500.
Okay. So I guess that was really my question. The 500,000 would be in a taxable account, and only some portion of that would be allocated to the Wealthfront 500. The rest would go to international, bonds, everything else.
That's right. And remember, the Wealthfront 500 is just the S&P 500. The S&P 500 actually turns out to be 80% of the market capitalization of the U.S. equities. But we use Vanguard's VXF ETF as a completion index to make sure that you still have the proper exposure to mid caps and small caps that you would normally have with VTI.
So if someone moves $500,000 to a taxable account, does Wealthfront sort of automatically do this, or is there some sort of option for the client as to whether they want to go that route versus just an ETF? Or I don't know why they wouldn't want to use it, but
No, actually, it's a very important point with us, right? We have a fiduciary responsibility to our clients. We're a registered investment advisor. We do recommend the service. We think it for our clients, it's the right idea. However, we never make these new investment features required in a Wealthfront account. So tax loss harvesting, when you join Wealthfront, or if you're an existing client of the service, there's actually a switch that you use to turn it on because you want the service. The same thing applies to the Wealthfront 500. Right? You can have a large account with Wealthfront and not use the service if you don't want to.
Right.
It's probably not surprising that most of our clients use the service.
I think it's a fabulous service. I sit here and I think, man, I've been missing out because, well, anyway, that's another story. Sorry?
This is really, the reason I'm so excited about this is, like I said, it wouldn't be practical to do things like this at this cost, right? Remember, the great thing about the Wealthfront 500 is there's no product cost.
Yeah.
Right? That ETF fee disappears. So for 25 basis points, getting this kind of value really wouldn't be possible without automating it in software.
Yeah, because there's no transaction costs beyond the 25 basis points, right?
For us, but we don't charge commission.
Well, that's what I mean. The consumer pays the clients pay the 25 basis points, but they don't pay individual transaction costs each time the Wealthfront 500 trades.
That's right.
Yeah.
And like a mutual fund and other services, we can do a lot of optimization on our end on how we trade, that volume of stocks. But, I have to be honest with you, as a software problem, these problems have already been tackled by large pools of money that the wealthy use.
Yeah.
They just haven't been available to the individual investors.
Yeah.
And we're very excited about bringing this technology down.
Yeah, it's a great feature.
Further in the future.
Yeah, it's a great feature. And when I started investing, goodness, almost 25 years ago, you didn't care about taxes because you didn't have enough to matter, right? I mean, it just even in the taxable account, But after you do it for a while, man, taxes are huge, and so that's a great service. Okay, I appreciate your time. I want to ask you, I guess, one or two more questions before I let you go, if that's okay. The first is, I guess maybe the primary one. To the extent you can share it with us, what's the future of Wealthfront? Do you have? I know there's probably some things you can't tell us, but where do you see Wealthfront and this industry headed in the next year or two?
I think a year or two is actually pretty short. I actually think that let me put it this way. We spend a lot of time at Wealthfront trying not to be obsessed with the short term, but really focusing on the long-term value that we think a company like this can bring to the industry. I mean, it turns out that every generation there's been the opportunity to build new, important businesses and financial services that have changed the quality and cost of investment products and service for individuals. We often point to Charles Schwab, founded in the mid-'70s, initially offering direct brokerage services for young people in their 20s and 30s at a low cost. Now Charles Schwab manages $2.5 trillion, offers a supermarket of financial services, and it really has forced the entire industry to shift how they handle financial services and brokerage. And I need to remind you that there's other firms like this, right? Vanguard is another great example, et cetera. We see Wealthfront as having that same opportunity. The big difference is, of course, is that those companies were largely built on the asset growth of the baby boom generation, which now has over $15 trillion liquid in the U.S. The millennial generation doesn't have nearly as much money, which is why they're not getting a lot of attention from the traditional providers. But for a new company like us, built from the ground up, this idea of building a service really optimized around what software can do for the individual investor, particularly the millennial investor, we don't see this as a 1 to 2 year problem. We see this as a multi-decade problem. I mean, Schwab is going on 40 years, and they're incredibly strong and growing even to this day. You can put us in the camp that's incredibly bullish about the future of this generation. I know there's a lot of economic struggles right now, but we see in our data that more and more young people are finding their way in the world. And the good news is that they're not buying into this idea that you can somehow beat the market by picking stocks, et cetera. They like the idea of passive investing. They're very conscious about fees, and they've grown up with software. And so we think that's a powerful combination to build a great company. When it comes to the next couple of years, I'll say that what I'm really most proud of this company, you have to remember, I was a client of Wealthfront a year before I joined the company. I opened my account a few weeks after it launched. But, we've come so far in less than 3 years. I mean, look at all the features we've rolled out. We started with the basic diversified portfolio. We added tax loss harvesting. We added asset location. We added Wealthfront.org, the single stock diversification service, the Wealthfront 500. And we will keep rolling out new innovative features because we really feel a responsibility as the leader in this category to help define the features and services and costs that, frankly, we think individual investors deserve. So over the next couple of years, I hope what you'll see from Wealthfront is a continued stream of innovative new features that challenge this idea that everyone really deserves sophisticated financial advice. We think we can make that powerful and possible through software.
Well, that's terrific. I'm just going to put in my vote for an individual 401k option and a defined benefit plan option for what it's worth. One last question. And I know your time's short. Both Wealthfront and the whole industry, this whole automated investment service industry, has grown up in the time of an incredible market. We really haven't had a bad market since these firms have existed, and we will. We're going to have bad markets, and who knows, maybe sooner rather than later. How do you think services like Wealthfront will fare when the market goes down 20 or 30% a couple of years in a row?
I think it's a good question. It's been coming up a lot lately because there's been a lot of anxiety about the U.S. economy and stock market performance. And I mean, let's face it, the 2008 financial crisis wasn't a run-of-the-mill recession or financial crisis, right? It's half a decade later, and we're still dealing with the aftermath. The truth is, one of the biggest things going for millennial investors is that actually in their short lives, they've actually lived through not one, but two market crashes. I mean, frankly, I think that's why so many of them are skeptical, almost cynical about this idea that either you can beat the market or that someone will protect you in a downturn, right? When I talk to our clients or I look at our data, millennials seem incredibly focused on their careers, on their family, on their friend experiences. You can make this long list of things they're focused on. Managing their money hasn't been one of them. And I think that's because the idea of automating your investment management makes sense to them, because they know that on a daily basis they don't have the time to do all the things they're supposed to do. And they think that most of their long-term success is going to come from their careers, right? The doctors think they'll be great doctors. The engineers think they'll be great engineers. The entrepreneurs who are starting new businesses think that that's how they're going to make their money. And so they really like this idea of an automated service. We actually did have some market turbulence this year in September and October. We had some more back in 2013. We're still a young company, but we've looked at the data. Vanguard has some fantastic data that we published on our blog that shows pretty conclusively that passive investors, index fund investors, don't seem to panic the same way that active investors do when there's market volatility. More importantly, our data suggests that actually young people, while they're unhappy when the market goes down, don't panic the same way as well. I mean, no one likes seeing their account go down, but if you're 28 and you think that most of the money that you're going to be worth in the future is not coming from your investment account, but from your future career, it doesn't lead to the same sort of panic that you might have if you're 60 and you're worried about your entire life plan and retirement being thrown around by being invested in the market.
Right.
So we'll see. I think this is parlor debate these days, and I think that everyone has an opinion about it. We're very optimistic about this generation. We actually think that young investors have been jaded enough about this idea that they can beat the market, that actually they're in the right camp in the aggregate, that they actually want to save regularly. They want to put their money into long-term investments. They know that there are best practices they should be doing. They're also self-aware enough to know that they won't do them. So they like this idea of delegating that to a service. And we're just finding that a lot of them like the idea of that service being in the cloud and running 24/7. They believe that computers are rational, right, and consistent. And so they like services like Wealthfront.
Yeah. Well, great. Well, listen, I really appreciate your time. Wealthfront's, you've obviously built a fantastic service for folks, and I appreciate your time today sharing it with us.
Yeah, happy to do it.
Well, I hope you enjoyed that interview as much as I did. There was just a lot of great information. Again, whether you ever use Wealthfront or a similar service or not. As I mentioned at the top of the show, I did open up an account. I am going to tell you why I did it in a future podcast. As you may know, if you've listened to my show for any length of time, you know I am crazy about the fees. Wealthfront's 25 basis points. And I think if someone said, oh, it's only 25 basis points, I would cringe. No, it's not only 25 basis points. It's 25 basis points. And in an upcoming podcast, when I talk about why I opened an account with Wealthfront, I'm going to address the cost issue because every basis point matters. It absolutely does. And the question you have to ask is it worth it for you? The answer for some may be no. I had one reader, and I'll actually pull up this email in a future show, but he emailed me and said he was moving out of Betterment and going to the TSP, the Thrift Savings Plan. He's with the government. It may have been ACE. I need to look that email up. But in any event, because the costs for the TSP funds are they're a couple basis points. I mean, you can't beat it. And so for some people, the cost, may not make some of these services worthwhile. And for others, it could be a godsend. So in my case, I think it is worth it. I'll explain why in a future show. But for today, I hope you enjoyed that interview. If you have any questions for Adam, send them to me. I'll be happy to forward them to him. Again, email is dr@dourroller.net. And as you know, email me about anything you want. I read every email and I respond to every email. Hey, hope you have a great day. And until next time, remember, the best thing money can buy is financial freedom.